All right, let's talk about a force that's completely rewriting the rules of finance. And you know what? It doesn't start on some Wall Street trading floor. Nope, it starts right in your social media feed.
I mean, you've seen this happen, right? Some stock, maybe a crypto coin, just explodes overnight with literally no news. All the old school analysts are just left scratching their heads. It's not about earnings reports or big CEO announcements anymore. So what is the invisible hand that's really guiding these insane market swings? Well, the answer is what some researchers are now calling the viral market. And it's exactly what it sounds like. It's a world where financial info spreads, well, less like a stuffy old report and more like a virus. The old rulebook, you can pretty much toss it out the window. You see, for decades, the big idea was something called the efficient market hypothesis. Basically, that a stock's price reflected all the known information. Sounds logical, right? But that theory is getting, well, pretty much replaced. Today, especially in these crazy, fast-moving markets, value isn't just about the fundamentals anymore. It's being driven by the digital pulse of social media, and that's what's known as the algorithmic contagion model.
So, if this is a market mystery, who's our number one suspect? Our investigation has to start with the thing that runs our online lives, the algorithm.
Think about it. These platforms, they're not built to give you a balanced, fair view of the financial world. No way. They are designed for one thing and one thing only, to keep you engaged, to keep you scrolling. They learn what you like, what gets you to click, and then they just feed you more and more of it. And that creates this perfect digital echo chamber.
And here's how that whole process works. It's this incredibly powerful feedback loop. Let's say you click on one positive post about a stock. Just one. All of a sudden, boom, your entire feed is flooded with similar, super bullish content. And all the contradictory stuff, the warnings, the skeptical takes, they just kind of disappear. They get filtered out. So that little hunch you had, it doesn't just get confirmed. It gets totally supercharged.
But here's the thing. The algorithm isn't acting alone in this story. Oh no. It has a very powerful accomplice, our own brains. Let's dig into how our own psychology kind of gets hijacked in all of this.
And this really boils down to two key psychological triggers. First up, you have overconfidence bias. The echo chamber just keeps feeding you stuff that confirms what you already think, and you start to feel like, man, I must be a genius. I totally saw this coming. And right on the heels of that, the algorithm hits you with loss aversion. You've probably heard of it as FOMO, the fear of missing out. You see that price chart going straight up and this primal fear just kicks in. I have to buy right now or I'm going to be left in the dust.
So what happens when you mix a powerful amplifying algorithm with our own predictable brain biases? Well, you get the recipe for a powerful and often totally irrational phenomenon.
And that phenomenon is called herding behavior. It's basically when we stop doing our own research, stop thinking for ourselves, and just follow the crowd. Now, researchers make a distinction here. There's rational herding, like if some terrible public news breaks and everyone sells. That makes sense. But what we're seeing online is different. It's intentional herding, where people are just straight up mimicking what popular influencers are doing, whether the fundamentals make any sense or not.
Okay, so all of this kind of makes sense, right? It feels pretty intuitive. But the really wild part is that this isn't just a theory anymore. Researchers now have the actual hard data to prove exactly how all this online feeling, this sentiment, translates into cold, hard statistics.
But that brings up the big question, the classic chicken and egg problem. Does the price going up create all the positive online buzz, or does the buzz itself actually cause the price to go up? To figure that out, you first have to find a way to measure all that online chaos.
And the tool they use for that is called a sentiment index. Basically, researchers use these programs to scan all the social media chatter, all the posts, the comments, everything, and they score it. Is the overall mood super positive, or is it really negative? This process boils all that noise down to a single powerful number they can actually work with.
And this is where it gets really interesting. When you take that sentiment index and plot it against an asset's price, well, just look at this. The correlation is impossible to ignore. As the online mood gets more and more positive, the price almost always follows it right up. The sentiment actually becomes a predictor of the price.
Now, to make sure this isn't just some crazy coincidence, researchers use a whole suite of heavy-duty statistical tools. They run all these sophisticated tests to basically separate the noise of social media from traditional stuff like company earnings. And what this does is it lets them see exactly how much of a price move can be chalked up only to what people are saying online. It's the proof that this digital herd isn't just an idea, it's a real measurable force.
So, there you have it. The evidence is pretty clear. This is not just some weird internet thing. It has massive, real-world consequences, and it's forcing regulators and investors to completely rethink the rules of the market. And I want to be clear, this isn't just theory. Look at these real-world cases. In Southeast Asia's fintech space, market valuations were being driven by sentiment on apps like Telegram. It actually squeezed out giant institutional investors. Or how about this? In Latin America's green energy market, the online buzz got so intense that the sentiment score became a better predictor of the price than the company's actual fundamentals. Think about that for a second.
So the big question becomes, how do you protect a market from an idea that's gone viral? The old tools we have, like circuit breakers that stop trading when a price falls too fast, they're just too slow. They only react after the damage is already done. That's why some experts are now floating a pretty radical new idea: sentiment-based circuit breakers. The idea is to pause the market when the online chatter itself reaches a fever pitch, to stop the virus from spreading before it can crash the entire system.
And all of this leaves us with one last, pretty profound question to chew on. If a collective belief, just an idea, really, gets amplified by an algorithm and can create billions of dollars of real-world value out of thin air, what does that mean for all our traditional financial models that are built on, facts and fundamentals? It forces us to ask a much bigger question about this new economy we're in. In a world where sentiment is capital, what is the value of the truth?